What's going on, everybody? This is Curtis. Welcome back to the channel, and today we're talking about the two most important rules when it comes to investing. They are number one, don't lose money, and number two, don't forget rule number one. These are two keys from the Oracle of Omaha himself, Warren Buffett. A lot of people have heard these two rules before, but in this video we're going to discuss why most new traders don't take these rules to heart, and I'll discuss a few tips for you to help you avoid the same problem. The first reason why a lot of investors don't follow these rules is that for a lot of them, the reason they got into trading in the first place is because they heard about someone else that made a lot of money buying the latest hot stock, crypto, or NFT. I'm certainly guilty of this too. I've told the story of my first and still best stock trade whenever the topic comes up. And since I just mentioned it, the year was 2013, the stock was Tesla, trading at under $40 a share and pre-split dollars. The stock doubled in a few months and I sold for a nice gain. While it's not unfortunate to make 100% gain over a few months, it is unfortunate to know that if I had held on over the long run, this would have been up over 12,000% and my $388 investment would have turned into about $50,000. That one trade gave me the itch to keep learning more about stocks, and it's a fun story to tell to a lot of friends. Stories like that may have gotten you excited about investing in the first place too. So what's the problem with swapping epic investment stories? Well, it causes people to chase these types of returns. However, these stories are more of the exception and not the rule when it comes to investing. The more likely story is following someone else's winning trade only to buy near the top and then hold the whole way down. These investments are oftentimes made with little to no research and follow more of a greater fool thing than anything else. Meaning, if I'm willing to pay X for a stock, cryptocurrency, or NFT, someone else is probably willing to pay 1.5 times the same amount. Additionally, a lot of new investors don't want to sell an asset when it goes up. They might think about selling after the first rise, decide instead to continue to hold, and then it goes up again. Since they're glad they didn't sell after the first rise, why would they sell now? What if it just keeps going up? They don't want to miss out on more gains. This does not mean you need to sell simply because something has gone up, but if you don't have a plan for when you want to sell, you might just end up riding it the whole way up and the whole way back down. This same kind of thing can happen in down markets too. Why buy now when it's down 10% from last week? What if it's down 10% again next week? So you keep holding back and never end up buying during down markets either. The second reason why most new investors don't follow the don't lose money rule is they don't look into, or maybe don't even understand, the downside potential for an investment. All they see is a chart going up and to the right, so they jump right on the bandwagon. It is not only important to understand the bear case for a stock, but also to understand how hard it is to come back from any significant loss. For example, a 20% decline requires a 25% gain to get back to even. A 50% decline requires a 100% gain to get back to even, and a 90% decline, like we've seen in a lot of stocks and cryptocurrencies and NFTs over the last couple months, requires a 1000% gain from that point to just get back to even. This is all to say that just because a stock was higher at one point does not mean it has to ever get back up there again. And a stock that has fallen a ton can still fall a ton more. In fact, just to put this in perspective a little bit, if a stock's fallen 50%, it falls another 50%, and then another 50% from that point, it's not even down 90% yet. So you could have bought in after that first 50% decline and still be down a ton from that point and not even be down as much as some of the other investments have been over the last couple months. So what can we do about this? Well, I'm not a financial advisor and this is not financial advice. But from what I've heard from other financial advisors, I'll tell you this. The simplest thing to avoid idiosyncratic risk is to buy ETFs and mutual funds instead of single stocks. If you dollar cost average into these investments, you should be alright over the long run, depending on which ETF or mutual fund you pick. But that's kind of the boring option. What if you actually do want to invest in a stock, crypto, or NFT? What should you look out for? Well, I have a few things here for you. And this is not inclusive, so there's probably other things other investors would probably recommend, but this is a good starting point for sure. The first is to understand how big the market actually is. There are a lot of stocks and cryptocurrencies that have been trading at extremely high valuations that basically assumes they're going to have the entire market over the next 3 to 5 to 10 years. This is probably not realistic, as most markets are going to be split up in some fashion, and that kind of means there's nowhere else to go from here either, so they're kind of fully valued at that point. Number two is to understand comparable multiples for other companies in their category. A good example of this is Robinhood. At one point after they IPO'd, they were trading at a market cap of over $40 billion with currently around $1.8 billion in revenue. Schwab, which is another online broker but also does wealth management services, was trading at a valuation of $170 billion with $19 billion in revenue. So that means Robinhood's trading at about twice the valuation to revenue multiple, while at the same time losing money every quarter compared to Schwab, which is profitable at this point. Now, third and probably most important on this list is to understand the company's competitive advantage, their competition, and the potential moat they have around their profits. To be a truly great company with consistent earning power, you need to be able to have a business that earns you money, that is hard to replicate for your competition, and gives you power over your suppliers. For a quick example of the perils of not having pricing power, there's a story of John D. Rockefeller where he's riding around town and noticed a new large house being built. He asked whose house this was, and it turned out to be one of his suppliers. He instantly stated that he's clearly overpaying this man and cut their rate. Now when it comes to competition, on the other hand, there are examples all around, but I think Netflix is actually a pretty good example here. They were the first company to streaming, but they didn't have a mechanism to keep others out of the market, obviously. Until others joined, they were getting all the best content at reasonable prices. Then HBO, Apple, Amazon, Hulu, etc. all joined in, competed for contracts, competed for creators, driving up the prices for all their services and driving down the margins on creating and licensing this great content. The general rule is that outside returns without a competitive moat will be competed away. The only way to prevent this is to have some really strong competitive advantage that doesn't allow others to directly compete with you or keeps them at an arm's length from you. If you're able to dissect a company and understand why others either cannot compete effectively with them or just cannot compete with them in general, you'll have a good idea of a company that has staying power, that can grow into a high valuation, and that can earn money year over year as others try and probably fail or maybe don't even try at all to compete in their market. This is certainly easier said than done, but this is a way to help prevent you from losing money on your trades. I'll be making some videos discussing this in the future, discussing which moats are best, helping you understand what kind of moats are out there, and why it's hard to compete in certain industries. Well, that's it for this week. If you enjoyed the video, please leave a like. Don't forget to subscribe for more content, and I'll see y'all next time.